another episode of Corporate CPR, where we breathe life back into your organization, projects, and processes, giving you insights to recovery and avoiding corporate mortality events. Today, we'll be talking about the impact of financial asset management has to your success, and joining us to contribute to the conversation is Devon Drew. Welcome, Devon.
Hey, thanks for having me.
Would love if you share a little bit about your background with the audience, please.
Yeah, absolutely. So I'm a 16-year Wall Street veteran, working at various asset managers, most recently a firm called Vanguard. Throughout my career, I've worked with other organizations like Merrill Lynch and JP Morgan. Throughout those 16 years, mostly in the New York City area, and most recently started a financial technology company which leverages machine learning and artificial intelligence to match differentiated, diverse asset managers with the product fit to the intermediary or wealth manager that has a product need.
Fantastic. So we have quite a diverse group of people who listen to our show. And so maybe we can just talk a little bit about kind of like the base level of what you mean by asset management and how that impacts, the everyday organization, just to level set.
Yeah, absolutely. And more than probably people think, right? So when you think of asset managers, think of a company full of individuals that manage money for, let's say, the state of New Jersey or New York, or the sovereign wealth fund, or a family offices, or financial advisors, to have Hartley plans, 401k plans. So these are the folks that actually manage the money. And when you look at what's comprised of asset managers within products, whether it's a mutual fund or ETF, you have individual holdings. So keep in mind, like, there could be a company like Vanguard or BlackRock that is the largest shareholder in pretty much every company, every public company within the Fortune 500, right? So talking about how they have an impact on the everyday consumer is that these asset managers have controlling interests in almost all of these publicly traded companies that folks work at on a day-to-day basis.
And so how does that tend to end up working then? What are the roles that the organization plays versus the roles that I guess they hire people for, and how does that, and what influence does the organization actually have then?
Has a tremendous influence, not only from of how money is managed, but also think about from a retirement standpoint, right? The everyday person, myself, you included, we want to retire with dignity. Now, in order to retire, or in order to have your nest egg grow with investments, you need capable individuals that are actually managing the day-to-day products that you're invested in. Right. So that's how from a organizational standpoint, you have influence. Also think about from policy, right? Think about the Federal Reserve, right? So from top to bottom, you have asset managers that are that actually consult on public policy, and Fed chair, and like the Fed chair, Jerome Powell, will lean on the expertise from these asset managers to be able to have a good grasp of the economy and how to move forward.
And how do companies then, I guess, make a difference and influence that type of, where the asset management companies are heading with their portfolio?
I'm glad you asked that. And now more than ever, the individual actually has more power than they actually think. You have, ESG, investing, which is environmental, social, and governance, that firms have to have a score with now. And now you have to demonstrate a demonstrable impact on these three key areas. And ESG is actually expected to grow to $53 trillion by 2025. And within that ESG, you have climate change, right? You have DE&I, you have you have governance, right? So there's guidelines now that these asset managers are being asked to adhere to in order to continue to work with clients. And then now also you have, I mentioned a little earlier that the end client is actually being able to create demand as well, because now more than ever, they want more diverse and impactful representation inside of the folks that are actually managing the money. So all of this is bubbling up to a big impact where folks like BlackRock are getting fired from different states because they're not adhering to what these states deemed as cultural similarities. So you're seeing it trickle down now to where, the everyday person actually has more of an impact than they think.
And so are there compromises then on returns if you're if you're being specific about, the types of companies that you're investing in and the maybe social good companies, et cetera, do you have to be willing to compromise on the ROI you're expecting in your portfolio, or can they perform just as well?
So the premise is that if an organization complies with some sort of, whether it's ESG or whether it's impact investing, the premise is over time, if these stewards of governance are actually adhering to being good companies, right, doing good things, and over time they will outperform. So that
Mm,
is so that's kind of the rationale behind that. And as far as on the S and ESG, a big portion of that is DE&I, and obviously diverse in thought, diverse in representation produces better results. And
mhm,
there's a study by the Knight Foundation. There was also a study by Harvard where they said, listen, it doesn't matter whether you're black, white, green, purple, right? There's no difference in performance, right? So if there's
mhm.
no difference in performance of your background, then why do, women and people of color have a 10 times harder time actually raising capital to be an asset manager, right? So there's all studies involved in, in that as well. In fact, women actually outperform men over time. So.
Mm. And with these large companies, um, with many holdings, when like the subsidiaries and other relationships, it's hard to trace back. I think sometimes as a consumer, which ones really are doing good and which ones maybe have a front of doing good while they have other organizations. Like, you just think of how much Disney owns or how much Walmart owns, Google,
Right.
you think you have this one product that you really believe in and don't realize who that traces back to. So how do these portfolio managers really make sure they're adhering to what the clients are asking for, I guess, and not getting, I get caught up in this, not understanding maybe the tentacles of some of these larger organizations?
Right. No, that's a really good question. It starts and ends with transparency,
Mm,
being able to look under the hood for, at these holdings, whether it is inclusive or an exclusive type of product, making sure that, if it's a company that has a, target of being carbon neutral by, let's say 2030, that they're taking the necessary documented steps to be able to do so. So it's a big effort, obviously. And I think that's where a lot of the consternation with some of these large asset managers, and I mentioned kind of BlackRock and their stance on, doing good, and these managers want to do good. And then also there is now indexes that track the character of CEOs, right? And I
mm,
just think of, I just think of, there's a organization called Rock Investments out of California, and they actually have a product that does a research that states good character CEOs over time will outperform bad character CEOs, and they have different
wow.
they have elements involved in that to make sure that that is measurable. But it's I guess it's not surprising, but being able to put a benchmark on that, things like that are now coming to the market where you could just line in the sand, this is a
Mm.
good company because of XYZ, this is not a good company because of XYZ. So you're seeing that now, and resources being put into that research.
So what do you think the biggest challenges are then facing the asset management companies at the moment?
Yeah, so if you look at the current challenges, is being able to adapt to the now and the next generation of everyday people.
Mm,
And there's a lot of, you're looking at the high watermark last year in asset management. space, it was $100 trillion globally, right? And looking at that, even based off of, let's call it diversity, right? 1.4% of all globally managed assets were managed by diverse owned firms, right? So out of the $100 trillion, I mean, it's like a trillion and change managed by diverse managers. So anytime you really want the percentage of the population to actually mimic and mirror the folks that are actually managing the money, because not only from a representation but also from a thought perspective. So getting more folks that are diverse in thought in the industry, right? You look to see different backgrounds, not just econ majors or finance majors, but liberal arts majors, right? And sociology majors, right? Because everybody's going to bring different skill sets to the table. So being able to groom the next generation of asset managers and folks that are actually managing the livelihood of these pensions and endowments and foundations and managing money for the end client, it's going to be paramount, and it's a barrier, but there's a lot of organizations, ours is one of them, that that is helping, leveraging technology to help do so.
And as a company, then what are the hardest things in deciding what asset management company to use, or even what's important for you as an organization, to like what your strategy is around that, and the funds you're picking, et cetera?
Right. So the asset managers we work with all fall into what we call diverse. And it's diverse in background, it's diverse in gender, it's diverse in asset class, and it's diverse in generation. Because you don't see too many millennials and Gen Zers in the space, right? But all those all together drive inclusion, and with inclusion drives differentiation in thought, and in turn will be differentiation in returns as well. Having correlations be different depending on the market conditions. So that's kind of my our company's secret sauce, is being able to have that mixture and not just the same old asset managers. Because thinking about it in this way, the top 20 largest asset managers are getting nearly half of everything that comes into the asset management industry. And when you think about a now coming down to an $85 trillion industry, thinking about, and especially in like the retail space, seeing just 20 managers is getting almost half of everything comes in the door, you're getting the same thought process a lot of times, right? So how can you have outsized returns and outsized outperformance when the DNA in a lot of these organizations are very similar?
But what about, I guess, like me as an organization, if I now want to, um, start building a pension fund, or change who we're using for that? What's the approach that the organization needs to get, take in making these type of decisions and having a good strategy, their corporate strategy for investing, I guess you could say?
Right. I mean, it starts with having an investment policy statement that adheres to what you believe in, how your money should be managed, and having mandates in place to be able to make sure that you do have the type of representation you want inside your portfolio. There's also consultants that specialize in making sure that your searches are unbiased and include everything that you want to include in them, and having the tough conversations with these asset managers. And now more than ever, they're being grilled with mandates, especially state specific mandates, of how they're managing money, different buy sell strategies. But kind of going back to this, the risk that these asset managers are coming across is that they're flat out getting fired right now. And the more asset managers are getting fired from lack of synergy within whether it's cultural or whether it's just your beliefs, the greater impact that's going to have and cause change for good in the asset management industry.
And so, I mean, is that, I guess culturally we have a lot of that just in general, right now with people getting let go for not being cultural fits, and is that, I guess, is there risk in that, and is it that a double-edged sword for these companies in letting people go for that, or have you seen any kind of adverse fallout?
Yeah, I mean, it just causes, it just causes these asset managers to rethink their strategy. And, you've
Mm,
seen that for representation on the board of trustees or their advisor board, right? Making sure that they have a well seasoned and also fresh faces, right? So having that balance
mm-hmm,
in place to make sure that from a policy standpoint, and from a fiduciary standpoint, they're being able to manage the financial well-beings of not only their clients' best interest, but making sure that they are working for good as well. And
mm,
mind you, every firm is going to be different. There's asset managers that are saying, hey, listen, we don't care about doing good. We want to make you money, right?
mm-hmm.
So, and there'll be a subset of the population that says, hey, listen, all I want my asset manager to do is make us money, right? Okay, great, right? So yeah, so to answer your question, there's enough for everyone. If the people that just want, hey, just create alpha, just create outsized returns for us, and we don't care about anything ESG, we don't care any type of social impact or impact investing. Okay, here, but the way the puck is going, especially globally, especially in Europe, you're seeing this where there is a large focus on firms that are doing good for the environment, that are doing good socially, that are doing good from a governance standpoint.
What, so I guess turning a little bit, there's a lot of conversation around crypto, and that's been going up and down a lot. Do you have, I guess, advice for companies and what their perspective should be on crypto, and whether that is at all a good investment, or if it's something to stay away from, and how does that, what is your advice
Yeah,
there?
we think that the underlying blockchain technology is going to be revolutionary. You're starting to see that across asset management now when it comes down to actually balancing the ledgers. When some of the books in the trading platforms, we do think that digital assets do have a space here. We're going to have to see some significant regulations that come out. So within that time, there's going to be extreme volatility. Looking at Bitcoin could go further before it goes higher. But I think what it does is it fleshes out the coins and the products that aren't really commercially viable and that
Mm,
don't have the utility of, let's say a Bitcoin. But for sure, cryptocurrency, it makes all the sense in the world. And maybe if we don't see it here in the United States, thinking about like Western Union, being able to send money on Western Union and the pound of flesh that they charge, and to be able to do that, real time, fast and efficient, and without the hefty fee.
right.
Looking at the emerging markets and looking at other places in the world, I mean, that is much needed, and it's going to continue to happen. And we're still in the very early innings. You think about the tech bubble, right? Is that, like what happens in 2001 where these tech stocks weren't worth the paper they're printed on. You weren't going to just abandon all the tech because you knew that there are greater use cases. Fast forward 20 years, and now we can't live without it. So we are at
Hmm.
the precipice now where, if you're looking at cryptocurrency, over the next, over the long haul, right, 20, 30 years, we definitely think it's going to be a greater part of the economy and be investable again, right? And even if it's in your overall asset allocation, even if it's a small, 1 to 3%, looking over the long haul, it can make, it can make a lot of sense after everything is fleshed out, of course, and regulation comes.
And do you think there's something, I guess, around that? You mentioned the word that I was going to bring up next is the utility. So is that what's going to drive up cryptocurrency? I guess as a currency by itself, there's probably not a lot of space for a lot of actors there, but ones with other utilities, is that what's going to be the differentiator, or of which ones are
Yeah,
successful as well?
Yeah, it's going to be, it's definitely going to be the ones that have that broad utility, right? Thinking of a Bitcoin, thinking of a Ripple, it's what kind of got everyone in trouble now is obviously with cryptocurrency. If you don't physically possess the thumb drive or wherever you hold it on, it's not yours, right? It doesn't, it just doesn't exist. So being able to actually have your cryptocurrency on an exchange where you don't own it, where you're just betting on the full faith of the exchange, that's a tough one, right? So I think people are going to learn a valuable lesson. And the number one rule in digital assets and crypto, it's like if you don't possess it, it's not yours, right?
Mm.
So I think people going back to the fundamentals of why they actually held it and invested in where they held it, is what's going to happen. I think there's, after regulation comes, and more education comes, I think people will be more equipped to stomach the types of risk, and you're seeing it, and I think what's going on, not only do regular people like myself on the street see the utility, but these large asset managers are seeing the utility as well. So you're seeing BNY Mellon that has the ability to custody digital assets, right? You're seeing BlackRock, the largest asset manager in the world, and Fidelity have digital asset solutions coming to market. So what's going to happen is there's a lot of projects that make a lot of sense that will go under because they don't have the funding, and with the fluctuation and volatility of digital assets. So what's going to happen is these larger organizations are going to come in like a thief in the night and sweep them up, put some research behind it, and grow it from there. And they have the capacity, and they have the balance sheet to be able to hold it for years, until it can start making them some money.
I think we've covered a couple of these things with cryptocurrency and like the ESG and diversity type focuses. But are there other key trends to be watching in this space?
Yeah, so as far as trends, the biggest trend that I see, how it relates, how it correlates Main Street and Wall Street, is the fact that over the next 20 years, you're going to see $68 trillion changing hands from Gen X and baby boomers down to millennials and Gen Z, right?
Hmm.
So that is something where if folks aren't careful in building trust and building communication, you're going to, you could see that 68 trillion, go to almost nothing, because if you look at generational wealth, 90% of the wealth is lost by the third generation. So it is imperative for asset managers, for the entire financial industry, to start building the trust, rapport, and communication with the now and the next generation of financial professionals and clients, because once the money starts being passed along to these next generations, and they don't have the trust in these asset managers, they're going to go do it yourself, and not good things could happen when that. And you saw evidence of that, of everyone in Robinhood, and everyone got over allocated over their skis in AMC and in GameStop, and all of a sudden things started reversing and they couldn't get their money out. Now, if
Mm.
there was proper financial advice and proper guidance, you would only have what your percentage in those type of stocks would be equal to your risk tolerance, right? So people wouldn't be freaking out and losing all their money because their friends were making money just a week ago. So that's a trend
Mm.
that I'm paying close attention to. That's a trend where, if we're not careful, and the stats don't lie, with 90%, 90% of the wealth evaporating after the third generation, then that could be significant if we're not up to speed with those demographic shifts.
And so, what are you seeing that you mentioned the building of trust? And so, what is it that generation trusts, or what things seem to be working?
Right, what they could see. So you're seeing
Mm.
the firms that are able to gravitate towards video content, whether that's on LinkedIn or Twitter or even TikTok, right? You're looking at young millennials and Gen Zers. 70% of searches are now on TikTok and not Google, right? So once again, as whether as asset managers, the stewards of trillions of dollars, if the messaging isn't really curated to adapt to changing demographics, there's going to be some problems, right? And people are going to make wrong decisions, and it starts with asset managers, and it trickles down to wealth managers, and then that trickles down to the everyday individual.
Well, and with like the TikToks and just a wealth of, I guess, information, whether good or bad information, but there's a wealth of information that exists. How, like, I mean, it seems to be creating a lot of self-proclaimed experts. So do you have any advice, I guess, a little more on that? Like, don't do it yourself, or don't just buy into the latest trends. I mean, how do you test what's good information versus somebody selling snake oil, I guess you could say?
Here's what I would say. If you look at the Dalbar study, it's a study that over the long term, it measures regular stock market participation, institutional versus retail, right? So the average person doesn't get half of what the market gives, right? And just to get market, you put $1 in the market, whether that is a ETF tracking the S&P versus someone that's doing it themselves, the average retail investor. The psychology behind it states that the average retail investor, which is me and you, are going to do the wrong thing at the wrong time. And because of that, the retail investor hasn't actually accumulated half the wealth of just setting it, forgetting it, not touching it, and just kind of letting it go. So that just goes to show that if we're taking advice and we're making any snap, rash decisions and acting at a greed instead of a long-term thought process, bad things are going to happen. And so what I would say is, financial advice geared towards the next hot dot or the next coin, whether it's Dogecoin or GameStop or any type of thing where you can accumulate wealth fast. I would stay away from that. Any type of long-term solution that you could, that involves, compounding interest and, being able to see your money grow over time. That's something I would take a closer look at.
No, it's great. Well, Devon, this has been a really insightful conversation. What things would you leave top of mind with the audience?
Yeah, so so there's been a lot in the headlines with cryptocurrency. There's been a lot in the headlines with inflation and market corrections and recessions. I would just leave whatever you do, have a long-term approach to it. There's no such thing as get rich quick, no matter how enticing it may seem. And when making life-altering decisions financially, seek a financial professional.
Yeah, absolutely. And then Devon, where can people get in contact with you or learn more about what you do?
Yeah, absolutely. So on all social platforms is at DFD Partners, and our website is dfd.ai.
Great. Well, thank you so much for taking the time to be on our show.
Thank you so much for having me.
And to our audience, until next time, keep your organizations healthy.